So today I'm going to talk a little bit about personal finance. Sometimes at the university I give talks to students and other people about borrowing and different decisions people make. This is an older presentation I gave from a couple of years ago, so some of the numbers are a little old, but the numbers still work. The idea here is whatever kind of debt you're going into, to use economics, and so we use some economic principles. That's a little bit different than getting advice from other people. And so one big point I always try to make is, they have seminars. If you're a college student, you think about student loans, right? If you're older, they have seminars on how to buy a house, and a lot of times people buy a car, hence the title, Don't Get Taken for a Ride. But college students might be thinking about student loans or car loans. Older people might be thinking about home loans. It's the same idea across the board. You can go to these seminars where people will tell you that now is the time to buy a house, and it may be and it might not be, but the person giving the seminar has an incentive to get you to buy a house, right? They make money if you take out a home loan. So, and the person who's thinking about you and your own financial situation is you. So, if anytime you think about taking on debt, you have to think about whether it's worth it or not. And if you know a little bit of economics, that will actually help you make a good decision. And that leads to lower costs, leads to less money out of your pocket, and also leads to better benefits. You get the thing that you're borrowing money for. It could be a car, it could be education or a house, but you wind up making a good economic decision. And so that's kind of what these talks are about. It depends on where you are in life, what kind of borrowing you're doing, but there's something that applies to all types of debt. So first of all, we're going to talk about how economics can apply, right? So when I talk about economics, I think about costs and benefits. And that's first of all, true costs and benefits involve more than just money. You have to calculate other things like opportunity cost. You have to think about things that are not money, not like wasting time, or sometimes, inconvenience can be turned into a cost. And then you think about the benefits, and they should always balance out exactly. If costs are greater than benefits, you're paying too much for something. But people sometimes don't see that if costs are less than benefits, something is cheaper than what you're getting out of something, you're actually leaving money on the table, right? If there's a coupon for something and you didn't spend it, you just wasted money paying full price. All right. The same is true for any decision. If there's something that's inexpensive to do that you can benefit from, it's actually costly to not do it, right? And a big thing that I always try to say is that using math actually can save you money and time in the long run. So there's always some sort of hidden calculation, there's always some sort of number that if you know the math, you can find it, and you can find the true cost of something, and you can actually wind up making a better economic decision. I always think about people who they go through the grocery store with a calculator and they figure out, does the big box really save you money? Well, you can do the math and calculate the weight and the price, and you might find out which is the cheapest to buy. And then again, if you get the huge box of something just because it's cheaper and you never actually eat the cereal or whatever, that's wasting cereal. It's wasting money too. So you always have to think about, what's the best decision for you. You can look at pure cost, but you can also think about non-monetary costs and other benefits too. All right, so today we're going to talk about borrowing. Okay, so the things that we're going to talk about mostly is kind of using interest rates, which is the price of money, and we're going to figure out how to use interest rates, money, and time to figure out like how much in a payment you might make, and how interest rates are the most important price in economics. And so they're the price of money, and they also have a component where interest rates transfer money over time. If you take out a loan, you're essentially borrowing money from yourself. Your future self is paying off your present debt. All right, if you save money, it's backwards. You're actually giving up money now, so your future self has more money. Right? So you can kind of think of it like two separate people, but interest rates are a price that actually brings economics and economic balance over time. Right? One big money mistake, we'll talk about a couple of them, but a lot of times people focus on the monthly payment. If you ever take out a car loan, they'll say, how much can you afford per month? Same thing is true for a mortgage. But the interest rate is hidden in there, right? If I borrow $10,000 now and I wind up making a bunch of payments and they add up to $12,000, there's some number that turns $10,000 into $12,000 over time. There's an interest rate hidden in there, but people don't think about that. Okay, and so that's kind of the idea of using the economics and the math to make a better decision, right? And finally, there's other fees whenever you borrow. Those sometimes might not be included in the price. They might be obscured. They might not be called, you might pay extra money. It's not called interest. You might be borrowing money for things you didn't know you had to borrow money for. That has to work into your economic decision, right? If you're doing costs and benefits, you have to think about everything you're paying for and everything you're getting, even if it's kind of hidden in there, right? Some fees are not disclosed. Knowing more information will help you have better outcomes in the long run. All right, so some of the costs, as I mentioned, non-monetary costs. Right? Would you stay up all night waiting outside the store for a deal? People do that on Black Friday. You save money, but you're giving up your time and possibly your sanity and even your physical well-being if somebody crushes you trying to get a TV. So include that in your calculations. Sometimes people will actually pay money to avoid inconvenience. Other people will endure inconvenience to save money. So that's kind of people's individual choice, but a good economic decision includes money and non-monetary decisions. Right? I mentioned before that costs should equal benefits. Essentially, you know not to overpay for things. You wouldn't pay $10 for something that's worth $1. But what people, like I said, they often overlook, if there's something that's worth $10 and you could pay $1 for it, you're kind of making a mistake to not buy it. Right? So you should, and it winds up equaling out that there's a sweet spot in economics where costs and benefits are equal to each other. Right? And so just keep this mantra in mind. Economics knowledge plus math equals better choices. If you understand the economics, costs and benefits, understand prices and markets, understand interest rates, as well as being able to do a little bit of division or subtraction in your head, you actually wind up making a better economic choice than you would have otherwise. Okay, so the big one for borrowing is the interest rate. Okay, so like I mentioned before, interest rates can shift money between the present and the future. And so I can borrow from myself. I can put, basically it's like I'm transferring money to my present self from my future self. And if I could run up a huge credit card bill today, who's going to pay it off? It's future me. So future me is paying for present me's mistakes. And if you go backwards, you save money. All right, you wind up pushing money into the future. And so this is the price that balances things. All right, so if I need money today and I need future me to pay me now, I pay interest. I actually pay extra money for the privilege of getting money early. If I push money into the future, I don't need it today and I can use it in the future in my savings account, I actually get paid money. So that interest rate is this price of money. And so I pay the interest rate that balances needs and usefulness. Like if I need a loan today, I'm going to get arrested because I didn't pay a fine, I could borrow money at a huge interest rate. It would be worth it to me. Right? But if I'm going out eating at a restaurant and I'm putting on a credit card, I'm going to pay 18%, and I could have done something else. Maybe that meal wasn't worth it. Right? So the interest rate might be worth it for some choices and might not be worth it for some other choices. But the interest rate actually balances present and future consumption, if you want to think about the economics of it. But it also allows you to get the money based on your needs now. Okay? So one thing you might learn in finance class is that the interest rate determines how long it takes for loan or savings to grow. All right, so if you have money and you're accruing debt, all right, you could be, if you have money, you could be accruing interest at the bank and you're watching your money grow. You could be accruing debt the same way. Sometimes people talk about compound interest or interest on the interest. And so if I'm earning money at the bank, I earn 1%, I'll have $101 on my initial $100 investment. But then I get an extra penny, right? And I'll have $1.01 the next year because I have the $100 is earning 1%, but the dollar is also earning 1%. So it's going to kind of snowball. Sometimes people get too rosy when they give you projections on how much your money will grow, and that's something to watch out for if people are talking about opening accounts. But let me show you this example first. So the rule of 72 is 72 divided by the interest rate, and that is years to double. All right. So if there's 3% interest per year, your loan or your savings will double in 24 years. Okay, now that's kind of higher than a savings account. It's lower than a credit card bill, but it might be good for a car loan or something like that. Now let's lower the interest rate and make it even lower. 5%, half a percent. Your money will double in 144 years. So if you have a savings account paying 0.5%, you're never going to watch your money grow. All right, and then 12%, which is more typical maybe for a high interest car loan or a low interest credit card, your debt will double in 6 years. Right, so you could have a credit card balance and never touch it. It's going to double over time. Now, you could raise this 18%, which is more typical for a credit card. Your interest will double in 4 years. Okay, so that's going to be, obviously your money is going to really snowball. Now, one thing that I always want to point out is that sometimes people will give numerical examples like telling you, like, if you save money at 6%, your money will grow. If you save money at 12%, your money will grow super fast, so you should open a savings account. The problem is if you look at what banks are really paying nowadays for savings accounts or certificates of deposit and so forth, they never pay as much money as the example might give. Okay, so a lot of times people might encourage you to save money by giving you an interest rate that makes it look like your money's going to grow super quick. But I really recommend looking at what banks are really paying. You can Google it. You can look up interest rate sheets for banks. Figure out. Usually, savings account is like less than 1%, at least in 2019. So that's something to watch out for. But a lot of people have credit card debts, and it's really easy to watch your debt get out of hand. If you stop making payments, your debt is going to grow, and then the interest that it accrues is also going to grow, and you can watch your money get out of hand really quick. Right? So that's why we need to understand the interest rate. High interest rates means your debt grows quicker. Low interest rate means your debt grows slower, but also means your saving goes slower. So you want to know this interest rate. Knowing the true price of something is something that everybody should worry about. Right? You wouldn't go into a restaurant and order a meal without seeing a menu and the price. You don't get surprised when the bill comes. Right? You don't look for, there's no hidden menu price at most places, but a lot of times when you're borrowing money, though, the price is hidden in there somewhere. Right, so a lot of times people make monthly payments, and what happens is, like, if you take out a car loan and you borrow $20,000, they calculate the $20,000 plus all the interest you're earning, and if it's a 4-year car loan, there's 48 months, right? So they take the total divided by 48, and then you get 48 equal monthly payments that incorporates the principal of the original debt and also the interest, right? And so there's some sort of period amount that is based on the principal and the interest. Okay, but if you look here, you don't have to do the formula, just look. The interest rate is in this equation 3 times. Right? So the interest rate drives the monthly payment, but a lot of times people don't look at the interest rate. And so the high interest rate that's hidden in there means that you're actually paying more in interest. And a low interest rate is obviously less in interest, but you don't see that. And so people look at, well, I can afford $200 a month. Well, that's not really everything in there. You might find out that the $200 a month is less toward the thing you're borrowing money for, and it's more toward interest, which is just literally giving money to someone else. So every time you know the real price of something, you make a much better real economic decisions. Okay, so if someone tells you to focus on the monthly payment, first of all, you can ask how much interest is in there, but you can also ask the interest rate. Sometimes people take out car loans and they say, like, here's a number of different banks. They're competing for your business. Which one do you want? You take the lower interest rate. Right? The monthly payment kind of hides that. It's in the formula, right? But you really have to look for it. Okay, so your monthly payment is obviously going to go up with the interest rate, but it can also go down with longer time. And so sometimes people will take, for a car loan, you can get a 4-year loan. It's pretty typical for a used car, but they might give you a 5-year loan. It's more payments, so it's less per payment, but there's more interest that you pay. Okay, so there's more interest paid. And so I'm going to show you some examples. You can calculate this online, but now they even have 8-year car loans. And so you're stretching your money out over 96 payments, right? Each one of them, pays off the money you're borrowing. It spreads it more thin, but the interest that you're paying is going to add up to more than if you had a shorter loan. Okay, so I'll give a couple examples, and I'm going to use 5% interest. I'm going to do a 4-year loan and an 8-year loan, and then I'm going to show you a much more predatory interest rate. Sometimes people don't have good credit. They don't pay 5%. They don't pay what the banks are offering or what the car loans are advertising. Instead, they get something that's sky high, and a lot of times it's people don't have documentation or they don't have a work history or something, and they go to certain car lots. And then it's a ripoff, and they don't tell you what the interest rate is. They just tell you the payment, and so I'll show you that. So what I did online was I took what's called an amortization calculator, and I'll show you a link, but you can Google it. And what you can do is you can plug in how much you're borrowing, how long you're borrowing it for, and it converts years to months here, and then put whatever interest rate you want. And I did this in 2016. All right, and so this is going to divide it over 48 payments. Right, so I kind of cut it off here, but first payment, first of all, every payment here is $345.44, and the pie chart shows you that it's mostly principal. You're mostly paying off a car. Right, this is a $15,000 car loan. Right, pretty typical. You do pay some chunk of interest over the total, right? And so you're going to make all equal payments 48 times. Every time you make a payment, you pay some principal and some interest. All right, because the first payment is mostly, you have a lot of debt. It's accruing interest faster. There's a bigger chunk of interest. All right, as you pay off the loan, right, you're actually paying much less interest every payment, and their later payments are paying up much more of the principal. Right? So your payments are the same. They're paying off principal and interest, but as you're paying off the principal, there's less interest to pay. right? But now look at this. The interest is accruing, and over for your $15,000 car loan, you are paying $1,581 in total interest. So it's an extra about 10% over 4 years. Okay, and so you find out that this interest rate, this loan, give you a decent amount of interest, but it's not ridiculous, right? What I did here though is I doubled the term loan in years. Okay, so this is the same $15,000 debt, but now it's 96 payments instead of 48. Same interest rate. Now goes up further, so it's not paid off yet. All right, and every time you're paying less per month, right? $190. So it is a lower payment, but over time you see that you're paying $3,230 in interest. So you're actually paying more in interest with the long loan. So it does cost you more. Now, some people probably perpetually have a car with payments, right? They never pay it off. They get a new car or something. And so it's kind of worked into your budget. Maybe it's worth it, but you're actually getting less car because you're paying more of this money for interest. Okay. Now, I'll talk about this a little bit later, but it's important to know it's like the $15,000 is not just the sticker price of the car. You might make a down payment, but a lot of times you're going to be financing things like the title and some other fees on there too. And so, and one big thing is if you get a warranty, right? So if you add a warranty to this, it's going to be accruing interest as well, and you're going to wind up paying more than whatever the warranty is worth because you're borrowing money for this service. Okay, now this is one that's extra. I kept the interest rate, actually I raised the interest rate, but I kept the payment back to the original one, but I made it 8 years, but a higher payment. And what this is I reverse engineered, I kind of backed out the interest rate, so it's $15,000 for 8 years, but the original high payment. Okay, in other words, this is a 23.3% interest rate. And some people really get this because, again, they don't have credit, they don't have paperwork, they can't show the credit history that they need. And so at a 23.3% interest, which is worse than a credit card, you're paying these payments for 8 years. A $15,000 car is $18,000 in interest. All right. So again, knowing the interest rate will really help you because you can do rule of 72. If you say, 72 divided by 24, 3. It's going to double in 3 years, and your car loan's for 8, right? You're paying it off more slowly than it's accruing interest. It's going to take you a long time and a huge amount of interest. So, knowing the interest rate is much more important than knowing the payment. This might look doable because I just showed you a loan that had the same payment. But if you say, what's the interest rate? And they say 23.3%, you can say, wow, that's going to double really quickly, and it's going to be a huge amount of interest. The interest is actually worth more than the car itself. Okay, so understanding that interest rate, the most fundamental thing. You always want to know the price of anything you buy. When you pay interest, you're basically buying financing. You're buying the access to something early. You get the car before you have the money. You get the house before you have the money. And so you pay for the privilege of having stuff sooner. Okay, and so a high price will change your mind on a lot of items. And so this car would be really expensive. You just have to know what you're getting out of it. If it's worth it, it's worth it, but know that this is part of the true cost, and it's extremely high. Okay, now that's the posted interest rate that I gave you, right? But like I mentioned, loans are often advertised as a flat monthly payment. They don't say like, hey, your interest rate is 23.3%. They just say, can you do $387 a month? Take it or leave it. So you could do the math and back out of it, but you can also ask. Okay, so sometimes legally people have to give the payment. So I kind of saw this at Home Depot where it said pay off a bathroom remodel for $200 a month or something, and it said in fine print at the bottom what the interest rate is. Okay, and so it can tell you like how much you're borrowing and what the payments are. Right, you borrow more money, it's higher payments. But here you could work out a formula, but it has kind of in fine print. It says 13.99 annual percentage rate. All right, so it's close to 14% per year, which is typical for a credit card or something. So it might look good. You get a remodeling project done, but it's a really high interest rate. Okay, and so by law they give you the information that maybe people want to hide because knowing the true price might make you not want to do business. Right, so keeping the price hidden might make you buy something. Right, knowing it might help you make better decisions. So legally, some people have to do it, but anytime you're in a position where you're given a monthly payment, you should ask what the interest rate is. Okay. Payday loans were notorious for this. A lot of times they're literally 2-week paydays, mean that you can get money now. You can borrow $100, you write a check for your payday at $120 or something, and so then they cash the check for more money in 2 weeks when you're paid. All right, and if you do the math, at least in Illinois, 400% is the cap. right? So imagine that. That's extremely high. Your money will double in far less than a year. And so people need to know that it's a huge interest rate. Now, sometimes people need that in various situations. It's better to have money in a market society. People can have a choice to take it or leave it. Maybe banning them is not the best idea, but giving people information is much better in terms of telling people what decisions they're getting into, right? Now, there are alternatives. Some companies have different, better financing. You might want to seek out one of those. But if you didn't know the APR, it doesn't look as bad, but knowing this, knowing what high interest rates do, you could say, wow, that's really high. Maybe there's some sort of way to get the money that's not this ridiculous, all right? A couple other hidden fees outside of payday loans and other things. I kind of mentioned warranties before. The thing about warranties, if you get, for example, for a car, they'll sell you an extended warranty. They'll add it to your monthly payment. You have to do a lot of math for that. All right, you're figuring out if it's worth it, and a lot of people try to figure this out on their own. But one thing is that they have it for appliances now. So if your refrigerator breaks, you could get refrigerator insurance. And because people don't have $600 for a refrigerator, they pay $30 a month for some sort of service to keep, if it goes, and they'll pay for it. You have to think about who's selling it to you and the fact that they wouldn't be selling it to people if they didn't make money overall. That's not a money loser usually. And so somebody's paying for it. You just hope it's not you, okay? So you get a guaranteed payment, but you're paying for it, and you might actually be paying more than you think because you're borrowing money to finance it, right? So they're making money on financing, and they're making money on the fact that they hope you don't use it, right? So there's actually math you could do. Basically, you take the probability of needing it, all right, and so maybe there's a 10% chance, but then you have to figure out what are the probability your costs will be covered. So notoriously, people try to make a claim and says that actually what broke isn't covered. So it's literally multiplying fractions, right? It's a 10% chance of needing it, and then if you do need it, maybe there's a 50-50 chance they do it. That's actually 0.1 times 0.5, that's 0.05 or 5% chance, right? So then you say, well, okay, what's 5% of a $600 refrigerator, all right? And then you might say, well, that's not worth the payment. Probably a better thing to do is just to put that money in savings and have some money in case something goes, okay? Because again, the companies have mathematicians basically figuring out whether it's going to pay out or not. Just like insurance companies have actuaries. These companies know what is the likelihood they're going to have to make payments on it, and then they make money on the financing. You might need it personally, but overall, the total sum of customers is going to pay more in than they get out. So that's just something to think about. Okay, and that's kind of a hidden fee, the fact that you're financing it. Different stage in life, they have home buying has a bunch of different fees, and I kind of mentioned this before, but if you ever go to a mortgage company and they tell you, what your mortgage is going to be, it's cheaper than renting, it's definitely time to buy a house, interest rates are low, then you should buy a house, or interest rates are high, that means they're going to come down, you should buy a house, it's always time to buy. Sometimes you see that these online and other mortgage calculations, they include mortgage only. And again, it's cheaper than rent. But when you make a payment to your mortgage company, you pay more than just the mortgage, okay? So one thing is that usually you pay fees. In Chicago, you could write a check to Cook County, but normally you pay your mortgage company. They put it in what's called escrow. They hang on to it and make the tax payment for you. So your property taxes are part of the bill every month that you get. You need homeowners insurance. They won't lend you money if your house isn't insured. That could be $100 a month. That is on your bill too. All right. And then finally, if you don't put 20% down, there's some sort of mortgage insurance, and that depends on what you buy. That could be $50, $100, $150. So again, you could have a big, you could have a mortgage that's $1,000, and then you add insurance, and then you add taxes, and then it could be much more than that. It could be 2,000 or something like that. So you have to figure out, when they tell you the mortgage, that's not every penny you're paying, and that's just the check to the mortgage company. If you rent and something breaks, hopefully your landlord will fix it for you. But if you own the property, you have to fix anything that breaks, plus you have to maintain it, and usually you have to figure out what a good monthly kind of amount to sock away to just put into maintenance. Right? And so if you're paying for it too, that adds to the cost of owning a house. If you don't pay that, your house will fall apart. Okay, so your actual check to the mortgage company that you have to write is bigger than just the mortgage. If they tell you what your mortgage is, that's not 100% of the price. And again, if things look cheaper, you do something. If things look more expensive, you might not do it. So you want to make sure that you are know the full cost. Okay, so the check you write is bigger than just the mortgage, and then the true cost of owning a home does involve a lot of maintenance that people sometimes forget about. Right? So when you're buying a car, you're buying a house, some costs are hidden. Some costs are not told by people, by people who want you to get the car warranty, right? They want you to buy a house. So always just make sure you have the information, right? What's the true cost? What's the interest rate? And then you might walk away and you might say, I can't, it's not for me, I can't do it. That's better than buying a house you can't afford. It's better than buying a car you can't afford. Right? So you have the choice, you have the information, you got to make sure that you're making the right decision for yourself. Okay? So a couple big takeaways. One, focus on the interest rate, not the monthly payment. You want the lowest interest rate possible, or you might be surprised by a really high interest rate that's obscured by the payment, right? So don't be afraid to ask. Okay. Another thing I always push is just, instead of buying some sort of warranty or insurance policy, and personally I've had times where I needed one and I had it. I've had times where I needed one and I didn't have it. I never really sat down and decided overall if it was worth it or not. But I always think about it, the fact that your chances of needing it and getting a payment on it for everything you do is you probably have more money at the end if you just put that money in a bank account and had it ready to go if something broke. All right, so I would say instead of buying some sort of a policy that you don't control, save the money, and essentially you're borrowing from yourself. Okay, so that could apply to a warranty, but it could also apply to different types of borrowing. So if you get a ticket or something, you need money now. You could go to a payday loan at 400% interest, or if you had a savings account, you could lend the money to yourself at 0 interest, essentially. And so I always tell people to borrow money from themselves. Okay, don't go to someone else with a huge interest rate. If you save money, you're kind of making that payment. You're providing your own warranty. But you could have money ready to go for an emergency, and then you're not paying someone 400%. You're not putting out a credit card at 18%. You're not going to the bank at 6%. You're literally borrowing from yourself. I don't want to say 0%, because if you take money out of the bank, you're not earning interest. But the cost is the interest rate on your savings account. So it could be like 0.5%. So I tell people that it's hard to save money, but it's even harder to owe people money at high interest. So one goal is always to save to borrow from yourself. Right? If you do want an amortization calculator, here's one. There's many others. But my whole point for today is just do the math. Okay, a little math will save you a lot of money. Think about costs, think about benefits, think about the total costs and hidden costs. And then the big math that we did, the big economic variable, was the interest rate. Knowing that interest rate is going to save you money in the long run, because your goal is to get as much as possible at the lowest payment to someone else. The less interest you pay to someone else means more money for yourself.